everyone. I hope you guys are well.
Morning.
Hello.
Or afternoon, I should say.
Yeah, time doesn't make any difference now, eh?
No,
We're all
it
in
doesn't.
lockdown. Let me just pull up my slides. Good afternoon, Anupam. Where's my slides? Oh, here we go. Okay, I hope you guys had a wonderful weekend. And as I mentioned yesterday, we are going to have a quiz this Friday, yeah? So the format of the quiz is exactly the same as before. You're going to have 15 multiple choice questions, and the topic will be on international parity conditions, okay? Anything else that you wanted to ask me before we start? Okay, if not, then let's start. So you will find that this topic is quite relevant for your assignment. In fact, in the assignment, you're required to use forward hedge and option hedge to hedge your foreign exchange exposure for Afterpay. So I hope through this workshop, you will understand how to use these contracts and how to hedge exchange rate risk using these contracts, okay? Besides the financial hedging instruments, you need to also be aware of different other considerations that people have to think about when they hedge their foreign exchange rate exposure, okay? So more details will be in your textbook. And we'll discuss some of the main points here as well in the summary. So in this topic, the focus of the topic is on how companies hedge their exchange rate risk. So as we mentioned before, if you have an international business, when you have to trade overseas, sometimes you have to pay in a foreign currency, or sometimes you receive money in the foreign currency. So the problem here is when you convert it back into the domestic currency, sometimes the cash flow receipts or liabilities might be different from what is in the contract, okay? So the purpose for this topic is to look at different ways the company can manage these risks. So in the first part of the topic, which is this week, so we'll focus on a type of exposure called transaction exposure. So in this case, what we want to focus on is we want to focus on the impact of exchange rate movement on cash flows, okay? So on a particular transaction, for example, in your assignment, that will be on the cash flows that you got from a foreign operation. Next week, we'll look at the different type of exposure, which is economic exposure. So this is when you look at the broad business and you ask what would be the impact of exchange rate movements on the value of my firm as in general, or on my competitiveness, right? So economic exposure is a little bit harder to measure, as you will see next week, relative to transaction exposure, where you only have one single transaction to focus on, okay? In terms of hedging techniques, you could be using either financial instruments like the derivatives transaction that we talk about in week 5, and also you could also use money market instruments, right? So in the exercises that we're going to do later on, we will look at how we can hedge financial transactions using forwards, options, and money market instruments. Alternatively, a firm could also change the way they operate so that the foreign exchange exposure, let's say on their asset side, could be offset by the foreign exchange exposure on their liability side so that the net exposure could be minimized, right? So one example is if you anticipate that you're going to expand your business to the US, so you're going to have your customers in the US, and your receipts would therefore be in the USD. So if you want to minimize the exposure on your USD receipts, you could also have your factories in America, or you could have some sort of operations there. So the expenses will be in the USD as well, and that will offset some of the USD exposure in your assets. Okay. So in the assignment, you would mostly focus on financial hedge, but it's also a good idea to talk about some operational hedge. So in one of the segments in the assignment, you've got to talk about different other considerations, right? So it will be a good place for you to talk about operation hedge. Okay. In terms of different types of financial hedge, the first one that we talk about is the forward hedge. So in this case, as the name suggests, you want to use the forward contract to hedge your exposure. Okay. So for example, if I anticipate I'm going to have to pay the foreign currency in the future, so in the future, I'm going to be short in the foreign currency. So one way for me to hedge that exposure is I'm going to enter into an opposite position in my forward contract, okay? So if I anticipate I'm going to be short in the foreign currency, I'm going to enter into a long position, i.e. I'm going to buy the foreign currency forward, okay? So that the gains or loss in my forward contract will offset the changes in the liability of my account payable, right? Alternatively, if I expect to receive the foreign currency, so if I expect to take a long position in the foreign currency in the future, then I want to take a short position in the forward contract to offset any movements in my account receivable, right? So this is something that we talked about before in week 5. So one thing to note is that if I choose to hedge my foreign exchange exposure using a forward contract, I basically fix the cash flow, right? So in other words, my hedge position will be a flat line. So to illustrate why that is the case, suppose I've got a long position in the underlying asset. So in this case, I anticipate I anticipate an account receivable. So in the future, I'm going to receive the money. So if I want to hedge the exchange rate exposure of this position, let me use a different color. Here we go. So if I receive foreign currency in the future, this is how my position is going to look like, right? So if the foreign currency appreciates, this is SD. So if the foreign currency appreciates in the future, my payoff is going to increase and vice versa, right? So if the foreign currency depreciates, I'm going to make a loss. So to eliminate any impact of exchange rate risk on my payoff, what I'm going to do is I'm going to enter into a short position in the forward contract, right? So I'm going to be selling the foreign currency forward of the exact amount of my account receivable. So essentially, I enter into an opposite position in the forward contract. Okay. So what I do here is essentially create a portfolio where anytime when my account receivable increases, my forward contract will decrease and vice versa, right? So anytime when I make a loss in my underlying asset, so if I'm here on the left of the graph, anytime when my position is in the loss, then the forward contract is going to make a gain, that is exactly the opposite of the loss that I make here. Okay. So the overall impact is therefore a flat line like this. Okay. So basically, using a forward hedge, I have fixed the amount that I expect to get from my account receivable in this case. Okay. So my overall position does not change with the exchange rate. Okay. So by using forward hedge, you pretty much know what you're going to get in the future. Yes, did someone want to ask something? No? Okay, let me move on then.
Yeah. Professor.
Yeah, sure.
Sorry for the delay. If you don't mind, I mean, like the concept is a little confusing. So if just you could go through it once more.
Yeah, sure. Let me erase all the ink first then. So with forward hedge, what you want to do is you want to enter into a forward contract that is exactly the opposite of your underlying asset. Okay. So in this example, what I have is I have an account receivable, right? So I long in the foreign currency. So here, if I have an account receivable, now if you think about a person that has an account receivable in a foreign currency, let's say this is the pounds.
Excuse me, ma'am. Sorry to interrupt you in between. Can I know
Yeah,
what do you mean by underlying asset?
So that's the position that you want to hedge. So in this case, let's say I've got 3,000 pounds that I expect to receive in 3 months' time. That will be my underlying asset.
You mean the payer need to pay us, like the bills amount, whatever is supposed to receive by us?
Yeah, exactly.
Right.
So here we have an account receivable. That means we expect to receive that much. So let's say I expect to receive 3,000 pounds in 3 months' time. So this is what I mean by the underlying asset. Okay. So usually if I don't have a forward contract, I would just wait for 3 months, receive the money from my trade partner, and I'm going to exchange the pounds in the spot market at that time to the AUD, right? So that is my underlying position. So if we have an account receivable in the pounds, and we expect to receive that in 3 months' time, right? So the risk that we face here is that in the future, in 3 months' time, the pound is going to depreciate, yeah? So we don't want the pound to depreciate because that means when we convert it back into the AUD, we will get less AUD than before, okay? So here you don't want the pounds to depreciate, okay? So one of the ways to minimize any impact of exchange rate risk on our position, let's say we don't want to bear any exchange rate risk here, right? So one way to do so is that you can enter into a short position in the forward contract on the pounds. In other words, I'm going to be selling the pounds forward, okay? To be exact, I want to sell 3,000 pounds forward by 3 months, okay? So if we recall from week 5, for a short forward position, our payoff function is F minus SD, right? Which means that we will be better off when the exchange rate depreciates and will be worse off when the exchange rate appreciates, okay? So if I want to graph the two positions on the graph, if I want to plot them on the graph, then as you can see on this graph, this upward sloping line here is my long position in the account receivable, right? So this is my underlying position as before. In terms of the forward position, because I have a short forward position and the payoff function looks like this. So with the forward position, this is how my payoff function looks like, right? So it's exactly the opposite of the long position in the underlying asset. Okay, so here is my underlying and here is my forward contract. They are opposite, right? So the implication of these positions is that it creates a portfolio where my payoff is always a flat line, okay? And this is F, which is the forward rate. So why do we get a flat line here for our hedge position? That is because these two lines always offset each other, right? So for example, if you look at the right-hand side of the graph, anytime when the exchange rate increases, so anytime when the pound appreciates, what happens here is when you look at the right-hand side of the graph, you will make a gain in the underlying asset, which means the value of your account receivable will increase as the exchange rate increases. But at the same time, that gain will be exactly offset by the loss that you make in your forward contract, right? So every time when the exchange rate increases, your forward contract will make a loss. And because these gains and loss perfectly offset each other, your position does not change, okay? Similarly, for the when you look at the left-hand side of the graph, so whenever the exchange rate depreciates, so it moves to the left, what you see here is that the underlying position, the account receivable, makes a loss or it reduces in value. But at the same time, because we have the forward contract, which makes a gain in this case, this gain will perfectly offset the loss that we make in the underlying asset, okay? So the net effect, once more, is a zero change in our position, okay? As a result, with a hedge position using a forward contract, you will always end up with a flat line, okay? So here, if you hedge your foreign exchange exposure using a forward contract, you will always end up paying the forward rate, okay, which is a fixed rate. Is this clear?
Yes.
Yes, Professor.
Shall we move on?
Ma'am, excuse me. Would you mind
sure.
if I add a few comments?
Yeah, sure.
Actually, what I think is basically, if let's say we have accounts receivable from British pounds, so let's say currently it's 1 GBP is equal to 2 AUD, and within 3 months it's 1 GBP is equal to 2.5 AUD. So when we receive the GBP, we get 50 cents more on each GBP. Is it what I should think when the currency rate appreciates?
Yeah, that's exactly the point. So when the value of the pound increases, that's when the currency appreciates. Yeah.
Yeah. Thank you.
Good, guys. So forward hedge, we have covered that before in the previous slide. And also if you want to revise this concept, you can go back to week 5 as well. The next hedging tool that we talk about is money market hedge. And luckily for our assignment, this is not something you have to worry about, Okay, this is not required in your assignment, but nevertheless, let's go through it. So with money market hedge, what you want to do is you want to use money market instruments to eliminate exchange rate risk, okay? So when you buy or sell money market instruments, you're basically just lending or borrowing, okay? So this is a scenario that might be useful when you don't have a forward contract for some reason, or the forward exchange market is not available. So in this case, with money market hedge, we have to set up a strategy where you lend and you borrow in two different currencies at the same time, okay? So in a sense, it's very similar to what we did before with the cover arbitrage, cover interest rate arbitrage, okay? Remember, we have to lend somewhere and we have to borrow money somewhere else, and then you convert the currencies, okay? So in the exercises later on, we'll have a few examples of money market hedge. Okay. So one thing to note here is as with the forward hedge, when you use money market hedge, the result or the outcome of the hedge is a fixed cash flow. Okay. So once again, we will end up with a flat line on the payoff graph, which is similar to what we saw before. So with money market hedge, it's a contractual hedge in the sense that you will always have to transact at the same rate, okay, regardless of how the exchange rate move. So normally I would like to, so these are the steps for hedging account payable using money market hedge. Right, so you could either memorize the steps or later on when we do the exercises, I'll explain to you how I think about these problems, okay? Or with account receivables, these are the steps that you follow, okay? But as I mentioned before, I don't tend to memorize the steps. I just think about the problem and then you work backwards, okay? We'll talk about this later on. All right, another important financial hedging instrument is option hedge. So this is quite relevant to your assignment, okay? So in your assignment, you need to use either a forward or an option contract to hedge. So in contrast to the previous two hedging instruments, with option hedge, in this case, it provides you with a flexible alternative to manage exchange rate risk, okay? So for example, if I have a foreign currency payable, so in this case, I expect to pay my trade partner in a foreign currency in the future, right? So if I expect to pay the foreign currency in the future, the worst case scenario for me is for the foreign currency to appreciate, right? So if the foreign currency increases in value, that will hurt my position because I have to pay more in my domestic currency, okay? At the same time, when the foreign currency weakens, right? So when the currency depreciates, this is when it's better for me because then I have to pay a little bit less than before. Okay, so in this case, if I want to manage the downside risk while at the same time maintaining the upside potential, then what I want to do is I want to enter into a call option, okay? I want to enter into a long call option position, right? So why is that the case? So for account payable, you want to be using a call option to hedge your position, right? So in this case, what you want is you want a contract that will give you financial compensation as the currency appreciates, right? And at the same time, you do not want to be locked in when the currency depreciates, because you want to take advantage of the currency being weakened. So a call option is more appropriate in this case relative to a put option, because with a call option, when the currency depreciates, that's when we look at the left-hand side, right? So in this case, you can leave the option lapse without exercising it. And so it will not hurt your position. In contrast, when the currency appreciates, this is when you need protection, right? So when we move to the right-hand side of the graph, this is when you need to have the financial protection from your derivatives contract, okay? And this is when the call option delivers. So when you move to the right-hand side of the graph, or when the exchange rate increases, this is when your call option generates a gains that will help you offset the loss in your underlying position. Okay. Does that make sense, guys?
So it's more circumstantial.
Yeah, exactly.
It's not a guarantee.
Exactly.
And people would choose this option because there might be a bigger profit involved?
Yeah, potentially.
Just over the other two with the guarantee. Sorry?
Yeah. Did you ask me a second question, James?
Yeah, sorry, I jumped in front of you. You answered the first one and saying there's a circumstantial with it. I was saying, why would they choose this one over the other two if the other two have a guarantee?
Good question. So the answer is, with the other two, right? So if I long and forward in this case, that means when the exchange rate increases and when the exchange rate decreases, it doesn't make any difference for me. My payoff is always the same. But in this case, when the exchange rate increases, which is on the right-hand side here, I've got some protection. But when the exchange rate depreciates, I can choose to not exercise my option and go to the spot exchange rate market and exchange the currency there. In this case, I take advantage of a weaker foreign currency. I'll show you later in one of the examples later on with the tutorial questions. I think with the numbers, it will be clearer.
Yeah, no worries. That makes more sense now. Thanks.
Thanks, James. So you can think of something like a car insurance. So normally you wouldn't want to go and claim on your car insurance. But when you have a car accident, that is when it benefits you, right? So an option is something similar. You would exercise when it benefits you. So within the account receivable, we could use the same logic, and we could argue that with an account receivable, an option will give you a bit more flexibility in terms of protecting you on the downside, but at the same time leaving the upside potential. Okay. So with an account receivable, in this case, you expect to receive the foreign currency in the future, right? So in this case, it will be good for you if the foreign currency appreciates in the future. So the upside potential is when the foreign currency appreciates. At the same time, when the foreign currency depreciates, that is when you will receive less in your domestic currency. Okay. So here you want a contract that provides you with protection on the downside, right? So when the currency weakens, at the same time, it should leave you some flexibility on the upside, okay? So when the currency appreciates, a contract should give you a bit more flexibility. Excuse me. Oopsie. That is not the correct payoff. So if you buy a put option, it will give you exactly that, right? So on the downside, this is when the foreign currency depreciates. So when the foreign currency depreciates, a put option will give you profit, and this will be the financial protection against the loss in your account receivable. At the same time, on the upside, when the exchange rate increases, you don't have to exercise the put option, which leaves you with some flexibility to take advantage of an upside movement. Okay. So I need you to understand the payoff of options for now, so that when we go to the tutorial questions, we can see how this hedging instrument provides us with a bit more flexibility. Okay. So relative to the other two hedging tools, with option hedging, it does not fix your cash flows. It provides you with a downside protection. So you know that the minimum that you're going to lose is a certain amount, right? So you know for sure that you're not going to be worse off more than this amount. And that at the same time, it leaves you some room to take advantage of an upside potential. Okay. So downside protection and upside potential. So to summarize, or to compare the differences between different types of hedging instruments. So we mentioned before that with forward and money market hedges, it results in a fixed cash flow, right? So your future obligation or receipt is known for sure, and it doesn't change with the spot exchange rate. With the option hedge, it's a little bit different. So in this case, it provides you with a bit more flexibility. So it allows you to control the downside risk, and at the same time, it does not limit you in the upside, right? So with the forward or money market hedge, let's say this is a long position, right? So this is account receivable. So in this case, even though a forward contract provides me with protection on the downside, so here if I compare the hedge, the forward hedge position and the unhedged position, you can see clearly that the unhedged position is worse off relative to the hedged position. But at the same time, with a forward hedge, it limits my upside potential, right? So in this case, if I compare the unhedged position and the hedged position, the expected financial outcome of the unhedged position is a little bit higher relative to the hedged position. Okay, so even though the forward contract eliminate any exchange rate risk, so you reduce the uncertainty of your position, but it's a little bit unflexible in the sense that it limits your upside potential as well. Okay, so you're not entitled to this. On the other hand, for a option hedge, let's say we have an account receivable again. The hedge position will result in something like this, okay? So on the downside, you've got protection from the forward, from the option contract. So I'm just going to compare that with an unhedged position. So for an option hedge position, on the downside, you're protected, right? So if you compare this with an unhedged position, you're better off here. At the same time, it does not limit your potential upside gain, okay? So because with options, you have the flexibility to choose when you want to exercise your option, okay? So it's more flexible relative to the other two hedging instruments, but at the same time with option hedge, you've got to pay premium upfront, right? Regardless of whether you exercise the option or not. So it could be a bit more costly. Okay. So we have walked through a summary of 3 different important financial hedging tools. Now, a key question that a firm or a financial manager is often faced with is the question of whether the firm should hedge or not, okay? So this is surprisingly not a very straightforward question, and that is because besides the expected financial outcome of a hedge, you've got other things to consider as well, okay? So one thing that you should consider is the cost of hedging. So hedging is not a cost-free exercise in the sense that you've got to search for the appropriate hedging tool. There will be transaction costs involved every time you trade financial assets. You need to have the right person, a risk manager, for example, for these activities, right? So it's a costly exercise. Also, if you think about a practical consideration of a risk manager, so let's say you're in charge of managing the exchange rate risk of a big company. So normally when the financial derivatives contract makes a gain, it's very easy to justify, right? So for example, in this case, let's say this is our account receivable. And to hedge this position, you want to enter into a short forward contract, right? So that your overall position is going to be this flat line over here. So it's very easy to justify that this is a position where you have 0 exchange rate risk. And if you have to report this transaction to your manager, when the exchange rate is here, right? So when you are on the left-hand side of the graph, it's relatively easy to justify the benefit of a forward contract in this case, yeah? Because it provides you with a gain here. However, if we think about the same problem, but if we are at the right-hand side of the graph, so in this case, your underlying position makes a gain, but your forward contract makes a loss, okay? So even though it's a good idea, I mean, if you just care about minimizing foreign exchange rate risk, entering into a short forward position is a good idea in this case, but practically it's very hard to justify why your contract makes a loss, right? Also, it comes down to the question of how the hedging instrument or the hedging strategy benefit the shareholders, right? In the end, the shareholders want to know how the firm value is managed. So along these lines, you've got to look at a few different questions. For example, do the shareholders in this firm need the firm to hedge in the first place, right? So do the shareholders, is it necessary from the shareholders' point of view for the firm to hedge? Okay. So believers of the efficient markets argue that shareholders don't need the firm to hedge because different people have different risk appetite. So I could be very risk averse, but some other richer person might have a higher risk tolerance. And in that case, maybe it's better to leave it to the shareholder to determine how much risk they want to take, okay? Rather than the firm trying to eliminate all kind of risk for the shareholder. The second question that you want to think about is it more efficient for the firm to hedge relative to the shareholders? And that might justify why a firm should go out and hedge their exposure in the first place, right? So something that you might consider here is that from a firm's point of view, they might be able to hedge in the wholesale market, right? So they could buy a forward contract of the size of $1 million, for example. Whereas for individual shareholders, when we hedge a certain transaction, we might incur larger transaction costs because the trade size is much smaller. Okay. Some other things to think about, which shareholders benefit. So, for example, if I am a shareholder, if I'm a domestic shareholder, the cash flows I want in the end is in the Australian dollars, right? But let's say there's another shareholder in the US and the final outcome that they want is in the USD, okay? So in this case, if I choose to hedge in the AUD, then that shareholder will be worse off, okay? So as a result, because of the diverse shareholder base that multinational companies have, this is another important issue that they have to think about, okay? So in your assignment, this is a question that you need to think about as well, okay? So from the point of view of afterpay shareholders, do you think it's worthwhile for the firm to hedge, or is there any other considerations that you need to think about, okay? Right. So we have gone through the main points for this lecture. And as I mentioned before, you will find that the materials we discussed today will be relevant for your assignment, okay? So to sum up, for the lecture today, we talk about transaction exposure. So we focus on hedging foreign exchange rate risk, specific to a transaction or a cash flow, okay? So for example, it's either an account receivable or account payable, okay? Nekis asks, what is the features of forward? Do we have to pay any fee upfront or when the amount is due, or what is the insurance? So with forward, you don't have to pay a premium upfront. So there might be transaction costs, but for the purpose of this subject, we ignore transaction costs. But no, you don't have to pay premium like in options. The forward contract is going to be settled when the amount is due. Yes, yeah, so at the maturity. Next, I don't understand the question about insurance. Do you want to ask in person? I'm not sure what you want to ask about insurance with forward contracts. Okay, last question. Yeah.
If you don't want to exercise a forward contract, so what will happen? Because in the option we just lose the premium, but in forward if we are not paying upfront and we don't want to exercise as when it's due, so what would be the difference and what's the feature of forward contract?
So forward by definition is a contractual obligation. So if you don't exercise it, that means you don't honor the contract. So by definition, you default on your contract.
It means we don't lose any money.
Well, I
In
didn't.
that case, everyone can have a forward contract, so whether they exercise it or not. I mean, what is the official contract if we don't want to exercise it?
So for a forward contract, by definition, you can't get out of the contract. So if you don't honor your contract, that means you default. So that means if you have a deposit or something, then you will lose that amount. Or if you trade, if you're a dealer on the market and you don't honor your contract, then the exchange will not allow you to be a dealer anymore. So you go out of business. So does that answer your question?
All right. So it means we should be having an account with a certain broker, for example, so we can keep trading.
Yeah, it's similar to that. So so that's a good example. So if you trade shares, for example, and you don't settle your shares, then your account is closed.
Because we can buy a contract and then end up paying nothing, and at the end not exercising. All right.
Yeah. So that's a good point. So so with these forward contracts, they are over-the-counter contracts, and normally they are traded between big institutions. So most of the time you don't have to have collateral and things like that. But so if you default on your contract, if you don't exercise, I don't prefer to use the word exercise here, because you have to exercise regardless, right? So if you don't honor the contract, then you default. Yeah.
I had a question.
Yeah, James.
If they have an underlying asset and they hedge accordingly and they have a no risk profit, in that terms, if they had, X amount of money, could they just up that and get more profit, or is there a limit to how much profit they can get for no risk from hedging?
Can you elaborate the question? What do you mean by profit?
So they have. Well, I guess with the underlying assets, you want to hedge, and so you might, because you're not getting any profit, are you? Why are you hedging? You're hedging to, eliminate the foreign exchange risk, correct?
Exactly.
But if you don't hedge, that means you won't get any profit, but there's only loss, correct? Or is there profit involved?
So if you don't hedge, you might either get a profit or loss, depending on how the exchange rate moves.
Sure. Yeah. So in that sense, if a person wants to hedge and to eliminate the risk, at that point, there's only potential for profit and no loss, correct?
No. So at the point when, let's say, if we have to hedge a foreign exchange rate exposure that is expected in 3 months' time, then at this point, we are not sure how the future looks like yet. So there could be a 50% chance that the exchange rate increases, or it could be a 50% chance that the exchange rate decreases.
Okay. And if it decreases, then we still don't lose anything, correct?
No. So if I have an account receivable, let's say I expect to receive £1,000 tomorrow. So if the exchange rate depreciates tomorrow, then I will be worse off.
Even with the hedge?
Oh, no, not with the hedge, sorry. So if you hedge,
not with the hedge. Yeah, correct. Yeah. But if it appreciates tomorrow with the hedge, would you get any profit, or would you just... No.
We ain't get any profit, no loss, bro. If we hedge at some point, it just be stable even in the future. If the foreign currency increases or decreases, we are going to get the same amount of money in the accounts receivable. At what place we are hedging. right now.
Yep.
Yeah, spot
So
on.
the only time we'd get a profit if we did the option market hedge, correct?
Exactly, yes.
And so that's probably why some people would go for that is to make the profit with
Exactly,
a
yes.
little bit more risk. Okay, thanks. That makes sense to me.
No, so with option hedge, you're not exposed to more risk. You actually pay a bit more to eliminate the downside risk and then leave your upside gain.
Right. So the only advantage from choosing is so you have to pay a bit more for option market because why would you just not do that all the time? You know, if there's a chance for profit.
It depends. Let's say if I'm very confident, let's say I have an account receivable and I'm very confident that the exchange rate is going to depreciate in the future. So in this case, even though, let's say I enter into an option contract, right? So if the exchange rate turns out to be a decrease tomorrow, then I will not make any profit. And yet I still have to pay the option premium. So these are the cases when I will be worse off with an option hedge relative to a forward hedge.
Okay. Thanks.
Yeah. So that's a good question. So the reason why options are not used all the time is because sometimes you don't have a profit from it and you actually pay more.
Yep. Okay, that makes sense now. Thanks.
Okay, thanks guys. That's good. So where were we? We are in the summary. So, so one thing to note is also when you talk about hedging, then the main focus is on risk management, right? So you want to somehow eliminate or reduce your exposure to foreign exchange rate risk. So in this sense, profits is not a very important thing here. So that's why some people choose to use forward hedge, even though they know that in the future, even when the exchange move in their favor, they will not get any profit. Okay. So with forward hedge, as the name suggests, you would use forward contract. With money market hedge, you would use money market instruments that involves either lending or borrowing. And with options, you use option contract. Okay. So for the purpose of this topic, as well as for your assignment, it's very important you understand forwards and options. Okay. So if you need to go back and revise these concepts, they are under week 5. Okay. What time is it now? So we are at 58. So in the next few hours, we are going to go through the exercises for today. But for now, let's take a 5 minutes break and we'll come back at 5 past. Okay.
Excuse me, ma'am.
Yes, sure.
Just wanted to ask, did we discuss about the assignments earlier?
Yeah, we sort of talked about it last week. Were you here last week?
Nah, like I was just in initial hours. Then I just left the class, so I didn't go through the recording. Okay, so if it is in the previous week, I'll go with the recording and I'll get to know about the assignment.
Yeah, or if you have any questions, feel free to ask me either through email or consultation.
Yeah. Sure thing. Thank you.
I think that would be more efficient.
Yeah.
All right, so I'll see you guys back at 5 past, okay?
Okay, thanks.
Okay, let's go through our tutorial questions. So as you can see with this tutorial, I only have numerical problems because I think they will be more relevant for your assignment as well. And I think they're quite complex. So I prefer to go through these problems with you in class. With the theory for this topic, I think it's not too much. It's mostly defining different hedging tools, so on and so forth. So I think you can read them at home. But the problems are a little bit more complex than before. So let's start with problem one. In problem one, we've got a company that have just sold something to another company, to a foreign partner. And so for this sale, they invoice 10 million euros, right? Payable in 6 months. So from the US company's point of view, this is the seller, so this is an account receivable for them, right? Now, for this company, the account receivable is denominated in a foreign currency, and it's a euro in this case, okay? This is a future receipt, so we expect to receive it in 6 months. We are given the forward exchange rate, and we are given an expected number for the future spot exchange rate, okay? So question A, what is the expected gain or loss of the forward hedging? Question B, if you are the financial manager of the company, would you recommend hedging or not? Question C, suppose that you predict that the future spot exchange rate is exactly the same as the forward exchange rate. Would you still recommend hedging or not? Okay. Alternatively, if the future spot exchange rate turns out to be $1.17 per pound, would you still recommend hedging? Okay. So let's take, if you haven't already, let's summarize the information that we have in the question. So here, the account receivable is 10 million euros. The time is 6 months, right? So we expect to pay, we expect to receive the money in 6 months. The forward rate is $1.1 per pound. And the expected future spot rate, so I'm going to write S6 for expected exchange rate in 6 months, $1.05 per pound. Per euro, sorry. Okay. So let's start with question A. So essentially question A asks, if you have a forward hedge positioned, what would be the difference? What's the expected gain or loss of this forward hedge position relative to an unhedged position? Okay. So in other words, what is the expected gain or loss of the forward contract? So it's similar to before. I am going to share a whiteboard. And I'm going to copy the questions on here. Okay. So if I have an account receivable and if I'm worried about exchange rate risk on this position, do you want to enter into a short or a long forward contract?
I think if we go with forward hedging in case of first question, it would be a loss for us, I guess.
And why?
Because at the moment the spot exchange rate is 1.10 and the forward exchange rate is 1.05. So it's 0.05 less than what we are getting right now.
No, the 1.10 is the forward exchange rate, and the expected rate is 1.05.
Oh, okay.
So I think you got it the other way around.
Okay, sorry.
That's okay. So let's go step by step first. Now, if I want to hedge this account receivable, do I want to be short or do I want to be long in the forward contract? So if I long in the underlying asset, in this case, the euro, then I want to be short in my forward contract, okay? So here I expect to receive the euro in the future. So this is a long underlying position. So to hedge this position, I want to take a short forward contract on 10 million euro. Okay. So here, if I have an account receivable, this is the euro, this is the future exchange rate, dollar over euro. So with my account receivable, because it's denominated in the euro, its value in the USD will increase when the euro appreciates. Okay, so we have an upward sloping line. In contrast, I enter into a short forward position. So here is my forward. So on this graph, I'm just going to label the graph properly. Here is 10 million euro. Okay. So on this graph, this point here, where the two lines meet, is the forward rate, which is 1.1. So if I expect the exchange rate to be 1.05, then I'm looking at the left-hand side of the graph, okay? So based on the graph here, can you tell me when the exchange rate is 1.05, which is what we expect, right? Would there be an expected gain or loss for the forward hedge?
So ma'am, basically we sell now and buy later in the future, is it?
No, all the transactions will be done in the future. So we receive the account receivable in 6 months, and we also settle our forward in 6 months.
So current rate is 1.1.
No, that's the forward rate.
Okay, so the forward rate is 1.1 and the current rate is 1.05.
That's the expected future spot rate. So that's
the payoff short forward will offset the loss of our underlying assets, so we'll be having a fixed amount cash flow.
Exactly, right. So we're going to be getting a fixed amount, and that's because the expected gain of the forward contract is going to offset the expected loss in the account receivable. Okay, so if I compare the unhedged position and the hedged position, so the blue line here is the unhedged position, and this line here is the overall, which is the hedged position. Do I expect the hedged position to be better off or worse off?
It depends. How likely is spot rate to be less than 1.5, 1.1? It depends.
Yeah, but let's say it's here.
To avoid the risk, we have to lock in forward.
Yeah, but let's say I'm very confident that it's going to be 1.05.
Definitely, we should go for short forward contract.
Exactly. And if I want to compute the expected gain or loss, then what would that number be? So I need a number here. I need you to calculate for me this number over here.
It's the difference between the two times 10 million?
Exactly.
500,000?
500,000. Exactly.
Oh, sorry. That's 5 cents, and then times that by 10 million.
Yeah, so I've got 500,000. Yes. Exactly right. So you want to compute the difference between the two rates. So between the overall position and the unhedged position, the difference is in the forward contract. Yeah. So here the expected gain or loss will be given by the expected gain or loss of the forward contract itself. Okay. So in this case, with a forward contract, with a short forward contract, the expected payoff that I get in this scenario is given by the difference between the two rates here, right? So 1.1 minus 1.05, okay, times the notional amount, which is 10 million euros. So here, the amount that I expect to gain or loss, or lose from the forward hedging is going to be $500,000. Okay. So in this case, with a short forward contract, I expect to make a gain. Yeah, because in the future, when the exchange rate turns out to be 1.05, I'm going to make a gain from the short forward position. Okay.
Sorry, I just have a question.
Sure, Anish.
Yeah, I computed the same calculation, but I'm not getting how are we getting like gain from this thing?
So if you have a short forward, your payout function is F minus SD. Yeah. And then you find a dollar payoff by times me by the notional amount.
Right, that's right. I got the same amount, like 500,000.
Exactly. So what's the question here?
But I'm not understanding how are we getting a gain from it? Or like, because what I think is if we have a current rate of 1.05 and no, sorry, it's like the current rate is 1.05, right?
No, that's the expected future exchange rate. It's not the current rate.
And the current rate is 1.1.
No, that's the forward rate.
Okay.
Yeah. So these are the rates that you use to settle your forward contract at time t equals to 6.
Mm-hmm.
Okay. So these are all for future settlement.
Right.
So the way you think about it is in a short forward contract, you agree to sell the euro at 1.1, right? Dollar per euro. And in the future, when the market rate turns out to be 1.05, that means everyone in the market who doesn't have a forward contract is going to sell the euro at only 1.5. But because you have the forward contract that you lock in before, you get to sell at a higher rate. Okay, so you sell at 1.
Right.
Yeah.
All right. Right. No worries. Thank you.
So that's where your payoff comes from.
Thanks.
Ma'am, do we get to know the current exchange rate?
Yeah, I can give it to you, but it's not very important in this case. Yeah.
I mean,
So,
is it useful to compare the profit or loss later in the future if we have a current rate? You know?
I wouldn't think so in this case. Yeah, because the transactions that you care about are the transactions in the future. And you don't really do anything with the current spot exchange rate for this particular question.
Okay. All
right, so question B. So now if you're the manager of the company, would you recommend them to hedge or not? So give me 2 reasons why hedging is good in this case.
I recommend them to hedge because as we have seen in the exam, like question 1A, that is it's from 1.1 to 1.05. We are selling and buying. I mean, we have a stable rate. We have set the rate, so it's not going to be a loss for a company if we hedge, right?
No, actually, in question A, you have an expected gain, right?
Yeah.
So if you hedge, then it looks like it's a good idea because you get an expected gain, financial gain.
Yeah, so we have hedged for 1.1, is it?
So you lock in the rate of 1.1, yes.
Yeah. So if you do that, we are good.
Okay. So according to what we computed in question A, the first reason why I want to hedge in this case is because I have an expected gain. So in this case, the hedge position turns out to have a higher financial gain relative to the unhedged position, right? So you compare this overall position with the unhedged. In this case, it's better off. The second reason is by hedging, I basically lock in a certain exchange rate. So I have 0 exchange rate exposure in this case.
Excuse me, ma'am. What in case instead of 1.05 it is 1.15?
Yeah, so we'll come to that in question D.
Oh yeah. I didn't saw that. Okay.
Yeah. Good question. So we'll talk about that later on. So let's move on to question C first then. So suppose the foreign exchange advisor predicts that the future spot rate will be the same as the forward exchange rate quoted today. So basically the expected future exchange rate is the same as the forward rate. What would happen in this case? And would you still recommend hedging or not? So here, my expected spot rate is exactly the same as the forward rate. Okay.
So as we are not exposed to any risk, it's not necessary to pay extra for any contract, so we don't need to hedge.
Yeah, so that's an idea. So in this case, because there's no expected difference, so why would we bother hedging? Okay. Any other idea?
But nothing's 100% sure or certain.
Exactly, right. So that's the dilemma that we have to deal with. We don't know what is the exact exchange rate in the future. Okay. So in this case, if I just look at the expected financial outcome, I could go through the same exercise as I did in question A and compute the expected gain or loss of the forward hedge. Okay. So in this case, my payoff is going to be, like Nick said before, it's going to be the same, right? Because my forward exchange rate is the same as the expected spot rate. Okay. So in this case, the expected financial gain from hedging is 0. However, something else I have to consider is I have to consider the risk. Okay. Uncertainty. So the question here is really how much risk tolerance am I? Okay. So if I am very, very risk averse, even though there's no financial gain in this case, I will still choose to hedge, because by hedging, I know for sure that the future rate that I'm going to settle the contract is going to be 1.1. In contrast, if I don't hedge and the future rate turns out to be different from 1.1, then I might end up with a different number. Okay. Now, in question D, in this case, I expect the exchange rate to appreciate. Okay, so I expect the euro to appreciate, which is a good thing for my account receivable. Okay. So in this case, if I want to compute the expected gain of the forward hedging, what do I get? So going back to Vivek's question before, now in the second scenario in question D, excuse my plotting is not very accurate. Here I've got my account receivable as before, and then I'm going to have the forward hedge. Then here I'm going to have my overall position. Okay. So when the exchange rate turns out to be 1.17, I'm going to be standing on the right-hand side of the graph. Okay. This is the forward rate 1.1, and this is 1.17. So here is my unhedged position. And here is my hedge position. Okay. So if I compare the payoff of the two positions, I can see that the payoff of the unhedged position is better relative to the payoff of the hedged position. Okay. And how much is the difference? If I want to compute the difference, I'm going to use the same formula as before. So for a forward contract, for a short forward contract, it's going to be F minus SD. Okay. With SD equals to 1.17 in this case. So as a result of the new exchange rate, my expected future gain or loss for the forward hedge is going to be a loss of $700,000. Okay. So in other words, in this case, it's a bit hard for me to justify the hedging instrument, given that the expected outcome is a negative outcome. Okay. So if you're a financial analyst in charge of the hedging decision, what would you recommend?
Not to hedge.
Not to hedge because?
It gives us a negative outcome.
Exactly, right. Any other consideration?
I just have a question that when we hedge, we don't hedge it on the whole amount, or it's on up to us, right? How much amount we have to hedge.
Yeah, exactly.
For example, like if it is $100 and we hedge 1.1 for $50, and if we don't hedge, we keep it as unhedged, the remaining $50, we can still claim 1.17 in future, right?
Yeah, exactly. Yeah, so that's what you do in your assignment. So you will hedge some proportion of your exposure, or you decide to hedge everything. Okay. But that's not really the main point here. So let's say in this case, I would either choose to hedge 100% or hedge 0%.
Oh,
let's
okay.
just keep it. Yeah. So let's just keep it simple in this case.
Right. Over here, we are making it 100%.
Yeah, exactly.
Oh, okay. Yeah.
Yeah, so normally with exam questions like this, we don't really make it very complex. You just either hedge or not. Yeah. Now, so this number that we just calculated is just an expected number, right? So this is a number that we calculate based on our forecast of the future. So in this case, it's a negative number, meaning that it looks like we are better off leaving our position unhedged. But is there any other considerations we want to think about?
Again, uncertainty.
Uncertainty, yes.
And how risk tolerance we are.
Exactly, right. So in this case, our forecast, there's a chance that our forecast might be wrong. And in which case the market might turn against us, right? Second, how much risk we want to take. Any other ideas? Right, so these are the things that you want to discuss in your assignment, okay? And also, like Anish mentioned before, with the assignment, you've got different scenarios where you hedge 25% or 50%, so on and so forth. So you've got to change your calculation accordingly, okay? But here for these exercises, I'm assuming that we hedge 100% all the time. Right, guys. So we have done question 1. So let's move on to our question 2. Okay. So if you want to take a snapshot of the answer I've got here, you're welcome to do so. So I'm just going to stop here for a few seconds for people if they want to take a picture. And then I'm going to move on. Okay. I did put some additional questions for you here, but I think you can do them at home later on. So take a screenshot of this slide, guys, and then at home you can do the questions later. So in this case, I just made up this questions where I put in an additional option, and you've got to hedge using options. Okay. Right. So let's move on to question 2 first. And if we have time, we can come back to that additional question before. So in problem 2, you've got a company that just purchased something from their foreign partner. So if you buy something, then you expect to pay, right, in the future. So this is an account payable for IBM. So here I've got an account payable. Now, the Japanese trade partner bill IBM 250 million yen, and this is payable in 3 months. Currently, the spot exchange rate, so S0, is 105 yen per dollar, and the 3-month forward rate, so this is F, is 100 yen per dollar. We also know that the interest rates in the US and in Japan are 8% and 7% per annum. So if I want to adjust this for a 3-month interest rate, I'm going to take this divided by 4. Similarly, for Japan, I'm going to take 0.07 divided by 4 to get the 3-month interest rate. Okay. So the management of IBM decided to use money market hedge to deal with the yen account payable. Okay. So in this case, if I want to hedge, I want to hedge 100% of this account payable using money market hedge. What is the dollar cost of the hedge? And show the cash flows involved in the hedge. Okay. So in this case, we are dealing with an account payable. So you can go back to the lecture slides to see what are the steps involved. Some people are more comfortable with having a step-by-step sort of guideline. But I'll show you later on how I normally think about the problem. Okay. So write down the information, and then I'm going to start a whiteboard and we can do the question together. Okay. So here I've got a company that has an account payable of 250 million yen. So this is an American company, okay? So in other words, in 3 months' time, IBM is expected to pay 250 million yen to the Japanese trade partner. The current spot rate is 105 yen per dollar. And the 3-month forward rate is 100 yen per dollar. Interest rate in the US. So this is already converted to the 3-month interest rate. And interest rate in Japan is 0.0175. 3 months. So suppose we want to use money market hedge instead of the forward hedge, okay? With forward hedge is very straightforward. You just have to use the forward rate here. With money market hedge, it's a bit more complex. You've got to use the spot rate and the interest rates in the relevant two countries. Okay. So as I mentioned before, with the lecture slides, you've got the step-by-step sort of instructions of what to do for hedging an account payable versus an account receivable, right? Well, this semester you've got an open book exam because it's an online exam, so I don't think it's a big problem for you. But in other semesters when we don't have an open exam, this is how I normally think about the problem. Okay. So in this problem, when we have an account payable, this is when we expect to pay the foreign currency in the future. Okay. So here I expect to pay the Japanese yen in 3 months' time. So when I set up the money market hedge instrument, I've got to set up so that in the future, in 3 months' time, I somehow end up with a 250 million Japanese yen, right? So I want to end up with a cash inflow of 250 million Japanese yen in 3 months' time so that I can repay the account payable, okay? So in my money market hedge, it has to somehow end up with a positive 250 million cash flows in the Japanese yen in 3 months' time, okay? And then from there, I'm going to work backwards to find what are the relevant transactions involved, okay? So if you think about lending and borrowing, if you think about the cash flows of lending and borrowing activities, so when you lend to someone, at the current time, at the time that you enter the contract, you've got to give the person the money, right? So you give the person, like, let's say, $100, and then you ask them to pay back in 1 year's time, $100 plus the interest that you charge on the loan, okay? So for a lending activity, you have a cash outflow at the start, and then at the maturity, you've got a cash inflow. For borrowing, is the opposite. So when you borrow money from someone, people will give you the money as the start, and then at the maturity, you have to pay back the principal as well as the interest at that time, okay? So as a result, if my money market hedging instrument provides a positive 250 million Japanese yen in 3 months' time, that will be similar to a lending sort of activity, right? So I borrow today. So I lend today. I give money to my borrower, and then in 3 months' time, they pay me back 250 million Japanese yen, right? And that will be the money that I use to pay my account payable. So as a result, in my money market hedging instrument, I'm going to have a lending activity in Japan. How much do I lend? I'm going to lend the present value of 250 million Japanese yen. Okay. So with a money market hedge, you would have two simultaneous transactions, one lending and one borrowing, okay? So if I lend in Japan, that means I'll be borrowing in the US, okay? So how much do I borrow in the US? I will borrow the USD equivalent of the present value of 250 million Japanese yen, okay? So let's call this X1. So in my borrowing activity, I'm going to be borrowing the USD equivalent of X1 at the spot rate. Okay. So let's see how that panned out. So in this exercise, I'm gonna conduct the cash flow analysis as well as showing you the final costs of the money market hedge as well. All right. So here in the first step, I'm going to be borrowing in the US.
2380952.38 dollars.
Sorry, can you say that again? Anish?
Yeah, is it 2380952.38 US dollars in borrowings?
238. Yeah, I've got a little bit different answer, but it's very close. I've got 2340. I guess because of the rounding.
Okay, okay.
Yeah, but it's very close. So I think your answer is right. I have accidentally erased on my whiteboard, so I'm going to go back to the slides, guys. I'm sorry for that. Okay. So we mentioned before that with an account payable of this kind, you want to be lending in Japan. The present value of 250 million Japanese yen, meaning you want to be borrowing in the US, the equivalent amount of the present value of 250 million Japanese yen. Okay. So that was where we were before I erased my whiteboard. So let's go through the exercise step by step. So we mentioned before that we want to borrow the present value of 250 million yen, right? So if we borrow 250 million yen in Japan for 3 months, we pay 0.0175 in interest, okay? So the present value of this number is about 245 million Japanese yen, okay? So you want to invest this much in Japan today so that in 3 months' time, you get 250 million Japanese yen to pay your account payable. So to have that much of yen as of today, so to have this money to lend in Japan, you will borrow in the US, okay? So how much do you borrow? You will borrow the equivalent, the USD equivalent of 245 something million Japanese yen at the current spot rate, okay? So here is what we computed before. And here is your current spot rate, 105, okay? So to show the cash flow analysis in this case, this is how it looks like, okay? So here I just rearranged the equation a little bit in terms of the time. So the first step is you want to, according to the previous analysis, you want to convert the dollar into the yen for your lending. So the USD cost for this money market hedge, as we show in the previous slide, is going to be the USD equivalent of this amount, okay? So as of today, you're going to exchange this much of USD into the yen so that you can lend in the Japanese market. So for this transaction, if we think about cash flows in 2 different currencies, in the yen because you exchange the USD for the yen, you receive this much of yen, right? In contrast, in terms of the USD, you have to pay the USD to buy the yen. So this is a cash outflow in the USD for you. In step 2, when you invest in Japan, so this is an investment or lending. So at the start, you have to give money to your borrower. So it's a cash outflow. And then in the future, sorry, this is time t equals to 3. In 3 months' time, you expect to receive this much of yen from your investment in Japan. So it's a cash inflow. In step 3, you use the money you get from step 2 to pay your account payable. So here, this is a cash outflow, okay? So these two offset each other. So if you compute the cumulative position at both time 0 and time t, you will find that in time 0, these two yen cash flows cancel each other out, and you are left with a USD cash outflow of about 2,340,000 something USD. Okay. So this will be the cost, the USD cost of money market hedge, okay, in the present value. So with money market hedge, if you follow these steps, as you can see, basically you know for sure how much you're going to, the strategy is going to cost you as of today, yeah? So this amount does not change, does not depend on the future movement of the exchange rate. So this is basically fixed, okay? Let's see what the next question is about. Option futures, option market, okay. So in a way, the money market hedge instrument have similar steps relative to the interest rate cover arbitrage that we talked about before in the previous topic, okay? So here you also invest in one country and borrow from a different country, okay? See what time? So we are at 56. Did you want to take a short break? And then when we come back, we can do the other questions.
Yeah, that'd be great.
Okay, so we'll come back at 4 p.m. Okay.
Okay.
Okay, let's move on to the next question. We do have a bit of a large number of questions for this week, so I don't think we can go through all of them, but some of the questions are similar, so I hope you can still do it at home if we don't finish today. So for problem 3, this is a very long problem. So here you've got an account payable. So here you visit a different country and then there's a bit of a cost involved and you've got to pay in 3 months' time, okay? So the amount that you have to pay is 5,000 Swiss franc. As of today, your spot exchange rate, so this is your S0. So 0.60. 3-month forward rate is 0.63. So this is F3. You could buy a 3-month call option, and the exercise price is 0.64, so this would be 8. The premium is 0.05, so this is little c. Assuming that your expected future spot exchange rate is the same as the forward rate. So in other words, your S3, the expected S3, is going to be the same as the forward rate. 3-month interest rate in the US and Switzerland is 6% per annum and 4%. So as usual, we want to convert the interest rate into into the 3-month rate first. So in the US, that will be 0.06 divided by 4. And in the Switzerland, it will be 0.04 divided by 4. Question 8, calculate your expected dollar cost of buying 5,000 Swiss franc if you choose to hedge via a call option. Okay, so this is something similar to what you're going to do in your assignment. The difference is in your assignment, you have to hedge an account receivable. Okay, so you want to hedge your income coming in from the US or the UK instead of a cost. Question B, calculate the future dollar cost of meeting this Swiss franc obligation if you decide to hedge using a forward contract. Question C, what is the rate that you will be indifferent between the forward and the option market hedges? Question D, illustrate that on the graph. Okay. So this question is about the future and the option contract. So I think question B is more straightforward. So let's start this question with solving question B first, okay? So if you haven't already, write down the relevant information and then I will start a whiteboard, okay? So here is my whiteboard and I'll try to remember not to erase it this time. Here's the question. Let's start with question B first. Okay. So before you do this kind of question, I want you to identify whether you have an account payable or account receivable first, okay? Because with this kind of derivatives contract, you need to get the long and short position right, otherwise your calculation will be wrong. So in this case, I've got an account payable, okay, of 5,000 Swiss franc. If I hedge using forward contracts, can someone help me first tell me whether you want to long or short the forward? And second, help me compute the USD cost under the forward hedge. Okay. So let's take about 2 to 3 minutes on this question. And in the meantime, I will write some poll questions so we can participate along the way. Okay, so in this case, if I have an account payable and I want to hedge it, do I want to long a forward contract or short a forward contract? So here, remember, I have to pay the Swiss franc in the future, okay? So I've got 11 answers, 7 for long and 4 for short. All right. So if we think about, let's say, if we get the chance to travel next year, and let's say we go to Switzerland, right? And if the cost of our trip is about 10,000 Australian dollars, now let's say 10,000 Swiss franc, okay? So if you want to be very sure of how much Australian dollars you should set aside for your travel, what would you do? Would you save up in the Australian dollars, or would you buy the Swiss franc along the way until you get enough?
I think Swiss francs.
You want to buy the Swiss franc, right? Because you sort of know how much you get along the way.
Right.
Any other ideas? So for me personally, I also think like a niche, right? So I will put money in my travel card, and I just convert it into the Swiss franc along the way. One of the reasons why I want to do so is because I want to know for sure how much Swiss franc I'm going to get by the time that I travel, okay? So one of the costs of doing that is that, well, from an investment point of view, when you lock in a certain, when you convert your Australian dollars into your Swiss franc today, then you forego the interest that you earn in your Australian savings, okay? So for us, we're talking about tens or 20,000 Swiss franc. It's very small relative to the amount that the corporation has to deal with, okay? So for them, normally they don't do that. They rely on the forward contracts instead. Okay, so this is what people voted for. So in this case, 11 people chose to long and 4 people choose to short, okay? So the answer here is we should be long in the forward contract, okay? The reason for that is that in the future, in 3 months' time, I know that I'm going to have to pay, oh, someone raised their hand. Cami, ready? Did you raise your hand? Did you want to say something? Okay, if not, I'm going to move on, okay? So, so in this problem, we know that in 3 months' time, we're going to have to pay 5,000 Swiss franc to our travel partner. And so we have to make sure that by that time, we have to have enough Australian dollars. Sorry, in this case, USD, because we're US citizen apparently. So we have to have enough USD to be able to convert into 5,000 Swiss franc. Okay, so in the future, the transaction you want to do is you want to convert from USD into the Swiss franc. And so essentially you're buying the Swiss franc. So as a result, to lock in an exchange rate, for me to settle this account payable, I'm going to long in the forward contract. Okay, so this will allow me to buy the Swiss franc at a fixed rate today. Okay. So here I'm going to be long in my forward contract on the franc. So I'm going to buy 5,000 franc forward. What is the USD cost of doing so?
We multiply it by the 3 month forward rate.
Exactly, spot on, right? So you want to multiply this by the forward rate, and that is 0.63. Exactly. And what is the answer, James?
Oh, I got 3,150.
Exactly. So if I hedge this transaction using the forward contract, the cost of doing so would be $3,150. So in other words, I lock in 3,150 to settle this transaction. Okay. Spot on, guys. Now let me move back to question A. Here's my slides. Okay. So in question A, you need to compute your expected dollar cost of buying the franc if you choose to hedge via a call option. Okay. So normally in an exam situation, you will have to determine whether you would use a call or put option. Okay. So a rule of thumb is if you would hedge the transaction using a long forward, then you would be using a call option. Okay. So long forward and call option are equivalent in terms of hedging. Okay. So here, because once again, we expect to pay the Swiss franc in the future, and we want to be protected on the upside, right? So when the Swiss franc appreciate in the future, our underlying position is going to be more expensive. Okay, so we're going to be worse off. So by entering into a call option, when the Swiss franc actually appreciates, you will get to exercise the call option, earn a profit, and use that profit to offset the increase in the cost. Okay, so that's why in this case, a call option is more appropriate relative to a put option. So if you hedge using an option contract, and in the future, if the exchange rate turns out to be a certain rate, the first thing you need to determine is whether you exercise the option or not. Okay. Shouldn't show you the answer. In this case, if the expected future spot rate turns out to be 0.63, the same as the forward rate, then would you exercise the call option? So with an option, with a call option, you need to determine whether you exercise the option or not. Okay. Depending on how the exchange rate looks like relative to the exercise price. Okay. So in this case, you've got to think about whether you want to exercise your option or not. Okay. And depending on, as you can see on the graph, depending on whether your exchange rate, your expected exchange rate, is greater or less than the exercise price. So I've got 6 answers so far. I've got 8. Got 10 answers. Interesting. All right, I'm gonna close the quiz now and share the results with you guys, okay? So we've got a fairly even option. So 4 people chose exercise the option, 4 people chose not to exercise, and interestingly, we have 4 people chose forward hedge is better. So if you choose option 4, can you explain to me why? Alternatively, if you wanted to explain to me why you chose a certain answer, please feel free to unmute your microphone. So in this case, you've got to look at the option payoff function to determine what you want to do with your option, okay? So ultimately, with an option contract, you want to decide whether it's profitable for you to exercise the option or not, okay? So in this problem, E is given in the question, which is $0.64 per Swiss franc. Now, suppose that the expected future spot rate is the same as the forward rate. It is going to be 0.63, okay? So in this case, the spot rate is less than the exercise rate, which is 0.64. So according to the graph, you would not want to exercise this option, okay? Because if you do so, you will be worse off. So you just leave the option worthless. So in this case, the reason why you don't want to exercise this option is because in the option, you are allowed to buy the franc at $0.64 per franc, okay? So if you exercise the option, you're going to buy the franc at this rate. When the exchange rate is at 0.63, this means that if you go to the market to buy the franc, you pay only $0.63 per franc. So as you can see, you would not want to exercise the option in this case because you will be better off buying the franc from the market, okay, rather than buying from the option contract itself, okay? So in this case, it's cheaper to buy the franc from the market, and therefore you don't exercise your option, okay? You just leave your option worthless. So at the expected spot rate of 0.63, you don't want to exercise your option, okay? As we mentioned before, you are here on the graph, right? So 0.63 is here. This is the payoff function of a call option. 0.64 is here, okay? So you will only exercise the option when it makes profit, which is on the right-hand side of E. Okay. So here you don't exercise the option, which means that you're going to be buying the franc from the market at 0.63. Okay. So in this case, the expected USD cost of this option hedge is going to be the same as the expected cost of the forward hedge, right? Which is 3,150. Now, what do I miss in here? So here I'm only looking at the payoff function for the option contract, but I forget about the option premium, right? So we mentioned before that the option premium is going to be paid upfront, regardless of whether we exercise the option or not. Okay, so similar to an insurance, you have to pay premium regardless of whether you exercise your insurance or not. So an additional cost that we have to take into account is going to be the option premium cost. Okay. So in this case, this is how an option cash flow looks like. When you enter into the contract that is today, right? So you go buy an option, you're going to have to pay the option cost upfront. Okay, so C is paid upfront. However, your payoff is computed at the time that you exercise the option, which is at maturity. Okay, so in 3 months' time. So as a result, if you want to compute the overall cost of the option, you're going to have to bring the option premium forward by computing the future value of the option premium that you pay upfront. Okay. Alternatively, you can bring P backward, but normally people will compute the future value of the option. Okay. So here to compute the option premium costs, you're going to take the option premium per franc. So in this case, it's $0.05 per franc. You're going to times it by the contract size, which is 5,000 Swiss franc. Okay. So this is the option premium cost that you're going to pay upfront at time 0. And then in the next calculation, I'm going to compute the future value of this option premium cost. Okay. So here, because I'm a US citizen, I'm going to buy the option in the US market. So when I compute the future value of the option cost, I'm going to compute it at the US interest rate. Okay. So here I'm carrying the option cost forward 3 months. So my future value is going to be 1 plus 6% divided by 4. So this is the 3-month interest rate. So the option premium cost in this case is therefore 253.75. Okay. Which means that the overall cost of option hedge is going to be the sum of the expected cost and the option cost, okay? The option premium cost. So overall, it brings me to 3,403.75 USD, okay? So the people that chose answer D from before was correct, okay? As well as the people that chose answer A. So in this case, the option cost is higher relative to the forward cost that we computed before, which is only 3,150. Okay. So one thing to note is that because this is an account payable, so both of the figures that we computed here are costs, right? And as a result, our net position is going to be the sum of the two cost figures. Okay. In contrast, if I have an account receivable, then I would expect to receive money, okay? So in this case, my first calculation is going to be a proceed calculation. So this is an expected cash inflow. However, my option premium cost is still going to be a cost, okay? So this is expected to be a cash outflow, meaning that the overall proceed is going to be a net figure between the two numbers here, okay? So net proceed is going to be the difference between the USD proceeds and the cost of the option premium. So that's something to bear in mind when you do the calculation for option costs, okay? So account payable, which is what we have in this case, you want to compute the total sum for the cost. Account receivable, you want to compute the difference, which is the net proceed, okay? So that sometimes it could be easily mixed up. All right, question B, we have done that before. Question C is a little bit tricky. So with question C, the question asks, what would the future spot exchange rate be if you are going to be indifferent between the forward and the option market hedge? Okay, so what would ST be if the two hedging tools provide the same sort of outcome? Okay. So I'll let you guys think about this problem for a little bit. Just one thing to note is that for a forward hedge, your hedging cash flow is fixed and it is known, okay? So in this case, this is what we computed in question B, which is 3,150. The only thing that we don't know is the outcome of the option hedge, okay? So this is going to be a function of the future spot exchange rate. So USD cost of the option is going to be a function of the exchange rate. So your job is to to find the exchange rate that equates these two, okay? So you want to find the exchange rate at which the option market hedge provides the same outcome as 3,150. So I'll leave you guys about 3 minutes to work through this problem, okay? So when I come back, we can discuss the answer together. Okay. So how do we approach the problem? So in this case, we mentioned before that with the option hedge, we always know for sure what is the USD cost of the option hedge, right? It's always going to be 3,150 because it's a fixed flat line, okay? The only thing that varies with the exchange rate is going to be the option hedge, okay? So what we want to find is we want to find the exchange rate at which the option hedge and the forward hedge are going to be indifferent, meaning that the outcome of the two are going to be the same, okay? So let's call that exchange rate X. So under the option hedge, if we let X be the exchange rate at which the two are the same, then we can rewrite the USD cost of the option hedge as 5,000 times X plus the option cost, plus the premium cost, okay? So 5,000 here is the Swiss franc, the amount of Swiss franc that we have, so the notional amount. And X here is the exchange rate that we use to convert from the Swiss franc to the USD, right? So X is going to be in the dollar over the USD, over the Swiss franc. The second component here is the future value of the option premium cost. Okay. Remember from question A, this is what we did in part A, okay? So we computed the option cost, the option premium cost in part A. Now, one important thing to note is that X must be no greater than 0.64, okay? Does that make sense? So X have to be either equal to or less than 64. Okay. Can someone tell me why that's the case?
It would provide a different outcome to a break-even point. What we're looking for.
No, I'm just asking why X have to be no greater than 0.64. Is that what you're saying?
Otherwise, it wouldn't be equal to forward rate.
No, not exactly. So remember with options, right? So an option contract allows us to minimize, to limit the downside loss, and then at the same time, allow us to take advantage of the upside gain, okay? So in this case, an option contract allows you to fix the maximum of the USD cost of your account payable, okay? So by using an option contract, your USD cost will look like this, okay? So on the upside, when the exchange rate becomes very high, when the Swiss franc appreciates, the option locks in a certain cost that you're going to have to pay, the maximum cost that you're going to have to pay. At the same time, it leaves a little bit of room for a potential of a lower Swiss franc cost, okay? So as a result, this exchange rate here that we use in this function is going to be anywhere from this point to the left, okay? If X is greater than 0.64, then you're looking at this straight line over here, okay? So this condition is to make sure that our payoff function is capped at this level, Okay. So in problem 6, I'm going to provide some more explanation with a proper payoff function for you guys. But this is why x should not be greater than 0.64. Okay. Otherwise, you're looking at this straight line over here. All right. So if you want to find the indifferent point exchange rate between the two option hedge and forward hedge, then you equate the two costs here. So if you do so and you rearrange the equation, you will find that x is $0.5793 per franc. Okay. So x is less than 0.64, so this is an acceptable solution. So at this rate, you will not exercise the option, of course, because it's less than 0.64. So this is the rate at which, if you plot the two payoff on the graph, then this is what you will see. Okay. So this is my forward hedge. And this is at 3,150. Here on the vertical axis, I've got the costs. Okay. So this is cost, not payoff. In terms of the option cost, this is how it looks like. Okay. So if you want to compute the maximum, I think it will be, let me get my calculator. So if you take 5,000 and you times by 0.64, and then you plus 253.75. So this level will be okay. So what it says here is that the USD cost for an option hedge is anywhere below 3,453.75. And the cost of a forward hedge is going to be 3,150, regardless of how this exchange rate moves. This is the point at which you're indifferent between the two options, because this is the point at which you get the same outcome. Anything lower than that, you will prefer the option hedge because the cost is lower. And anything above that, you would prefer the forward hedge, okay, because it's cheaper. So here you're going to choose option, and here you're going to choose forward, okay. So this goes back to James' question before about why people don't always choose forward, why people don't always choose option hedge. This is exactly it, right? So that's because sometimes the option hedge is more expensive than forward. All right. So question D, you want to draw a graph that plots the payoff functions of both the option and forward hedge position. This is what we did before, okay?
Sorry, I have a question.
Yeah, sure, Negis.
But in general, we never cap our option gain. So in a specific example, we just capped it. But always with potential gain possibilities.
Exactly. So that's when you talk about an option contract by itself. So here I'm talking about the combined option and the underlying position.
It means to purchase both contracts?
No. This is an option hedge position. So I should have said this is an option hedge position. So with this position, it is comprised of an option contract and the account payable. Does that make sense? So this shows you the overall costs that you're going to have to pay.
Cost diagram. Yeah.
Yeah, yeah. Similarly with this one, this is the overall position when you have a forward contract as well as the account payable. If you want to formally show the payoff function of the two options and forward hedge positions, for the forward hedge position, like Nekis mentioned before, this is going to be comprised of two things. The first thing is the underlying position, which is a short, which is an account payable of 500 Swiss franc. The second thing in your portfolio is your long forward contract, right? So the cost function for the forward hedge position, as we shown before, is going to be 3,150. Okay, so far so good. So here we have a flat line. An option hedge position, on the other hand, has two components. So the first one is, once again, your account payable, so your underlying account payable. And second, your long call position, right, with the strike price of 0.64 and an option premium of 0.05. Okay. So here I'm writing the cost function as well. Just be careful here because I'm looking at costs, right? I'm not looking at cash flows or payoff. So anytime when I have to pay, I'm gonna write SD for costs. And anytime when I receive a cash flow, I'm gonna have a minus sign. Okay, so that's a little bit reverse. So this is the cost function of the combined option hedge position. So if I break them down into two, for SD greater or equal to E or SD less than E, then this will be my payoff function, okay? So as you can see, with an option hedge position, you've got two components. One is a fixed line at 3,403.75, and one is an upward sloping line, which is given by this equation here. Okay, so if you plot them on the graph, it will look like this. So it's going to be an upward sloping line up until E, which is 0.64. And then from here onward, it's going to be a flat line of 3,403. Okay. So once again, this is a little bit confusing because it's a cost function, okay? So here, you cap your costs at a certain amount, and then you have a potential to lower your costs if the exchange rate depreciates, okay? If you want to combine the option and the forward hedge, it's going to look like this. So this is 3,150, okay? So I think you should take a screenshot of this slide because the solutions provided by the textbook does not have the detailed step-by-step breakdown of the functions, okay? So I think this will be a bit more detailed. I'm just gonna write ST here so we know. Okay, so unfortunately, we have only 6 minutes left. So I'm just going to talk through the last two problems a little bit so you can attempt at home. I'm happy to go through these problems again next week if you want, or I can talk about it during consultation or email, so on and so forth. So with problem 5, this is a bit, so you've got to think about this problem a little bit before you start. It's not complex computationally, but it's a bit, you've got to get your head around the concept of options, okay? So in this case, you've got a company, an American company, that gives their client a choice between paying in the USD, $10,000, or paying in their own currency, which is a Swiss franc, of $15,000, okay, in 3 months' time. So essentially, the American company provides the Swiss company with a free option, okay? So you've got an option to choose your payment currency. Question A is quite straightforward. You want to compute the implied exchange rate between $10,000 and 15,000 Swiss francs. Okay. Question B, you've got to think about it a little bit. So you've got to think from the point of view of the Swiss company. Okay. So given the option that the trade partner gives the Swiss company, and given the spot rate that you expect to be in the future, what is the Swiss client going to choose? Okay. Question C. Now, this question C requires your understanding of how option contracts work. Okay. So option contracts are contingent contracts in the sense that you can choose whether you exercise the option or not. So for question C, think about where the exposure of the American company is, right? So in this case, they allow their trade partner to choose either to pay in the USD or in the franc, okay? So their exposure comes from this second option, okay? So once you identify your exposure, then you want to choose a contingent derivatives contract that allows you to hedge the exchange rate, okay? So think about it a little bit. It's a little bit different from the previous questions that we have done before. So I just wanted to talk about it. I think that's the final questions, no? All right. Yeah, so one more question. This is not very hard, but this is a long question, okay? So in question 6, you're going to have to use all the 3 financial hedging instruments that we talked about before. Money market hedge, forward hedge, and also option hedge, okay? So question 6 is quite standard. You just follow the steps. So question 6 will be a good chance for you to revise the previous exercises that we have done before. Okay, just be careful with the exchange rates here. So sometimes it's quoted per dollar and sometimes it's quoted per yen. Okay, so be careful when you convert the currencies. All right, I only have about 1 or 2 minutes left, so maybe I should leave the time for you to ask questions if you want. Any last minute questions or comments before we conclude? We're very quiet today, guys. Okay, so if there's no question, then I will conclude the class for now. So as usual, if you have any questions, feel free to email me or book an appointment. I think if you want to go through some exercises, it will be better to book an appointment. Or if you have any questions about the assignment, feel free to email me as well. or book an appointment. Okay. Other than that, then have a good week, guys, and I'll see you guys next week. Okay.
Thank you.
Yeah,
Thanks.
thank you.
Thank you.